After a decade of discourse, the bad bank is finally here. So, what is good about this bad bank and why is it all in the news? Basically, it is a brainchild of IBA, that is the Indian Bank Association, and our Honorable Finance Minister, Srimati Nirmala Sitharamanji, announced a few days back about this massive reform that everybody is discussing or debating or sort of criticizing. So the actual aspect or the actual purpose, the goal of this bad bank will be to absorb all the bad assets. Some terms I'm going to write here. To absorb the bad assets of the bank, which is already reeling under the mind-boggling number of the NPAs. Believe me when I say that banks have written off, again, a word, banks have written off more than 10.8 lakh crore loans over the past 8 years. Again, there's a word, bad loan. So this bad bank, which is actually going to be a combination of two entities, that is NARCL, National Asset Reconstruction Company Limited, and IDRCL. Basically, NARCL is what we are going to majorly discuss about. It is predicted, the analysts have suggested that if these reforms all things go according to plan, then it will help clean up banks' books or banks' balance sheet in a massive way, and not just clean up or write off that the bad loans the banks that have been doing. There are various terms involved here. We are talking about NPAs. The What exactly is NPAs? What exactly is bad bank? What is provisioning? How exactly is all this cumbersome accumulation of this is going to work? This combination is going to work. Now you might be wondering, I've been boasting myself as a science student. So what craziness prompted me to take up this subject, which is so closely related to the finance sector, which is already dwindling, and it is affecting the economy in the long way. And I'm not experienced, but believe me, between a certified chartered accountant crunching balance sheet numbers all day long and our very own Jasprit Bumrah blithely claiming that mutual funds sahi hain, and then immediately after that the ad says that mutual funds are subject to market risk, please read the offer document clearly before investing, or what we call in Hindi वित्तीय जोखिम के अधीन. So that is not exactly explaining how we are going to invest or how our money is going to grow. So between those two extremes, I am willing to bet that your time is going to be worthwhile if you invest that time in the explanation, in the presentation, in the vivid infographics, and the lucid and comprehensive manner that I am going to deliver this presentation. Is not about data. Okay, 10.8 lakh crore, 36,000 crore guarantee given by the government. These are all in the newspapers. It's about collating that data in a particular presentation. Presentable data is to be there. And I'm going to make sure that you get the most out of it. It's not about the basic concepts, the structure of the economy. How many of us really know what the economy, how the economy is functioning, and what all is going on in the background, why the bank employees are already on the streets protesting that it's just a cover up for the bad loans, it is not going to. And we've already discussed, we have already prompted the previous measures such as the insolvency and the bankruptcy code, the IBC. So these time and form, then we criticize or we get into an altercation with our government that they are just inventing and implementing one policy over the other and getting into debates and arguments in the parliament. Anyways, all those aside, we are going to get to the gist, we are going to get to the bottom of this today itself. You just have to keep an open mind and don't think that if I'm going to discuss a topic such as balance sheet, then I'm going to explain a balance sheet and I'm going to take all day long to crunch numbers and explain each and every but the important aspects I'm going to discuss with you. With that, we'll begin. And these concepts which we so often hear but we just neglect. Okay, NPA, okay, no doubt it's a common, it's being for decades. So with that, we'll get to the gist. Now, what is the bad bank? It is also referred to as an asset management company. Again, another word, asset. We'll get to that. Is a corporate structure which isolates illiquid and high risk assets. Mostly you have to understand illiquid. What does this mean? Again, you can see the combination, you can see the connection even with economy and science. Illiquid, liquid is a state of matter. So, what exactly in layman terms we can say, like water, liquidity is something when an asset can be immediately exchanged or it can be brought into transaction. For example, cash. We go to a shopkeeper, we want to purchase dal or we want to purchase gehu or wheat, we want to purchase bajra, so we just give him the money and he offers his services in return. But at the same time, if you have a bond or fixed deposit that is going to mature over 5 years or 10 years, or a government security or a gilt edge security or a debenture that's going to yield a certain amount of money after a long period of time, you cannot just ask the shopkeeper to wait, I'll give you money of the after 5 years. So that similarly, the assets, the high risk assets which are not profitable anymore because of various sundry reasons which we are going to discuss. So, also referred to as asset management company, which isolates illiquid and high risk assets, typically non-performing loans held by a bank or financial organization or perhaps group of banks. Now you understand the basic. What is it? Is basically we are remodeling, like we have clay modeling, a pottery. Imagine it as a pottery. The assets we are going to remodel, where there are various ways in which we can do that in order to produce a valuable, make the assets function again, which have been not been yielding profits or any sort of uh, interest whatsoever. Now, these are my notes. These are very comprehensive. Some terms which the day-to-day terms which we need to be aware of. Whether I am studying in 6th standard, whether I am 70 years old, we need to know this. Normally, we ignore these when we study these in the newspapers. So, first of all, we talk about a bank. What is a bank? Simple, a financial institution that accepts deposits from the public and creates a demand deposits while simultaneously making loans. I'll explain that in the next slide, what exactly the process is. Then we have the asset, which we are majorly going to talk about. What are the illiquid assets? What are the non-performing assets? We use term as bad loans. We use the term in the previous slides as the high risk assets. A resource with economic value that an individual corporation or country owns or controls with the expectation that it will provide a future benefit. For example, a father, in a layman example, a father considers his children as assets, but if they are all lying around and playing PUBG all day long, then that becomes a liability. Anyways, liability, something a person or company owes, usually a sum of money, may include loans, accounts payable, mortgages, government corporate bonds, warranties, accrued expenses. Again, lots of terms, a million of terms, but these will be explained, the important will be explained. So basically liability is something that is going to be a person who is incurring a liability. He is expected to repay with or without interest, and he's whatever he's been credited with, the funds he has been supplied with. In case of banks, they are expected in due course of time to return them. Then we have investment, an asset or item acquired with the goal of generating income or appreciation. Investment in some ways is just like savings. The major difference is when we deposit our money in a savings account which we have opened in any bank, be that a public sector bank or a private sector bank, then it is more or less safe and we are bound to get that interest, although it is very small interest, 4.5% or 4% of interest on that money, but it is a liquid asset, we can say, asset on the part of the customer or us or we ourselves who are depositing, but it is a liability because bank is obligated to pay the deposit back with the interest as and when the customer desires. Investment is when we are talking a lot of investment. Savings deposits are not working, they are generating, they're not allowing the money to grow. And the inflation rate, if we assume the inflation rate in general terms, if the inflation rate is already 5% to 6%, and savings account interest is giving 4.5%, so obviously the people, in order to see their money grow, they will venture out to invest or deposit their money in some other scheme or other avenue, which will give them which will accrue to them a better amount of interest. And that is where the various bonds, the debentures, the mutual funds, the equity market. Although we have to note that as the interest value that is going to accrue to you on a particular deposit or investment goes up, so does the risk, because nobody is going to give you an additional interest or additional money. Everybody is going to keep hold of as much money, as much amount of money as they can, and nobody, unless and until you are willing to take a risk. And that is what it is all about. So this is investment. Then this term will be in the debt. Security is a debt instrument that can be bought or sold between two parties and has basic terms defined, such as the notional amount, interest rate, and maturity and renewal date. It's basically a type of certificate. For example, we talk about government bonds or sovereign bonds, which are also known as gilt-edged security, not GUILT, that is not GUILT, but GILT. That is, they are extremely safe, because fortunately our government has a high sovereign rating. When we talk about the Moody's rating, the Fitch's rating, although they are international organizations, they manipulate and they downgrade or they're willingly or according to their whims and fancies, but our sovereign structure is very strong, and it can issue bonds to not only the retail investors, not only our own banks and financial institutions, but even to governments or financial institutions abroad. We are very much secure that those bonds will definitely bear certain interest, which will be given back to the person or the organization which has been, to whom the bond has been issued. So that is, we are debt security. Why this is important? Because in today's lecture, we are going to talk about debt restructuring along with asset management and reconstruction, because it's all about the bad loan. Bad loans happen because you have a liability. You have the obligation of returning or compensating to a particular creditor. Creditor is someone who funds you, who will give you funds for running your business. Some initial, we can say, capital which gives you the opportunity to grow, because bank in itself, it cannot generate money on its own. It's just an intermediary between two sides. One is the customer, one is who is depositing the money, who is investing, and one is the bond. One is the organization or the individuals who are providing it the funds to invest, and then those funds, they are roaming around or going around in a nice little cycle, which we are going to study in detail also. And finally, we'll come to NPA, that is the problem. NPA is basically refers to a classification for loans or advances that are in default or in arrears. Again, these are economic terms, but not to get afraid of it. Default or in arrears. For example, I'm talking about if I have taken some home loan, or I have taken some loan for a car, and I have to return that loan along with the principal and interest. I have to give it back to the bank, because it's bank's money, obviously, after all. So that period, if after 5 years, if five on the fifth year and 1 day, or after 1 month, I'm not able to repay that loan, that complete principal amount, the installments which I'm supposed to do, then I will be in default. So similarly for a bank. This, I think, is clear to you. These are some of the basic terms which you need to keep in mind when we are discussing. Then this is the major stuff. Now, the unbalanced sheet, there's just a word play, a kind of wisecrack. Actually, it is a balance sheet which has been explained not in terms of numbers but by an infographic by nice looking icons. So it does not overwhelm anyone, whether he's a beginner or an expert. Basically, assets we are talking about which are going to generate income, which are going to benefit the economic institution, financial institution in the long run. So assets, this is a bank, this is a major financial entity which we are going to save. We are going to restructure its assets, we are going to restructure its debt. Then loans to customer, I say, when I am a customer, I am taking a loan, that is a liability for me. But when bank is issuing a loan, not only do we have to return the principal amount, if you remember maths, when we say that we have taken a loan or we have made some deposit, then we calculate the simple interest, that is Pandit Totaram upon 100, if you remember. So this gives us a simple interest. Similarly, there are other interests, compound interest also. So not only do we have to return the bank, the principal amount, but also an interest. So this loan is generating money for the bank in the form of interest, and moreover, the principal amount will also be returned to the bank as and when the maturity date arrives. So this is an asset for the bank. Then investments for the bank, again, not only the individuals, not only the common retail investors, not only the citizens of India, but the bank is also making investments, maybe on behalf of the individual who has a deposit. It's making investments in mutual funds, it is making investments in debts, it is making investments in gilt-edged securities and other debentures and sundry other various other terms. So this is an asset because it is going to yield some amount of money, growing amount of money after it has increased, it has attained a certain increased value. So this is an investment. And finally, asset is cash. Now cash as it is, it will not grow, but it is an asset because it can be used to purchase or it can be used to reimburse the individuals who have demand deposits or who have savings deposits in the banks. So these are the major assets. Balance sheet has two sides, assets, then we have the liabilities, which are the major issue with today's banks. Again, if I go back, I've also put some nice buttons in it. So liabilities, we have discussed something a person or company owes, usually a sum of money and all this. Then so liabilities, this is the capital or the equity part. This is money from shareholders and investors, and this is the retained profits. Basically, if you have heard of a term initial public offering, or when a company is established, a company is not owned by a single individual. There are a lot of there are even the common man will can obtain or purchase a portion of that company in the form of what is known as share. Now that share is 1% or 0.5% or 50%, that is up to the company or whatever structure it decides. So basically, money from the shareholders, the equity, it is known as the equity part. So the money which the investors or the shareholders have sort of invested or they own in the form of, so it is a liability. Why it is a liability? Because normally when we study the basic accounting equation, the assets equal equity plus liability. Equity holders are going to be returned their money at last. What that means is, if a bank is going into liquidation, again, liquidation means in simple terms, we are going, if a bank is not performing at all, if it is burdened, it is laden with tremendous amount of stressed assets, and it has become extremely unprofitable, then all its assets are going to be sold. And when assets are going to be sold, the money that is going to be obtained, first it is going to the major debt holders because they are the senior most, and then finally whatever money is left or is not left, that is going to go to the equity holders. So another, we have discussed the capital, now we are discussing debt, which is the major issue. So loans, now these are the loans which the creditors again here the terms are relative. Creditors is some outside entity, whether it be another corporate institution, financial institution, or an individual. It is offering some money to the bank, and that will become the creditor. In the case of banks, when bank are issuing the loan, when I am taking, the creditors are who are depositing, they are offering some amount of loans, they are offering the bank some amount of money in order to run their business. And that loans, why it is a liability? Because like here, the loans to customer, bank was earning an interest on them. Similarly, here the loans which the creditor is providing to the bank, when it will return those loans to the customers, then the bank will have to issue interest. It will become the opposite of this situation. Then we have the deposits from customers, as we have discussed. We have the savings deposit, the time deposits. So the deposits, that is also a liability, because the bank has to shell out additional money in the form of interest to offer to the investors. Then we have the debt securities, that is, if the debt securities is from the part of the bank. In term, it has debt security, basically it has offered a certificate that it will provide a certain amount of money along with interest to that particular corporate organization, or government, if the case is of government bond. And it has borrowed some money in terms of some written stamped paper, that is debt security. So that is a liability again, because for on that basis it has to shell out some additional money. Now what we have observed here is what is happening in why the loans, why the balance sheet is becoming unbalanced, is because the loans which are been given to the customers, people like Nirav Modi, people like uh, our very own Vijay Mallya, they have taken huge loans. But since they are unable, due to various reasons, whether they are willful defaulters, various other terms are there, or they have become bankrupt or insolvent, they are not able to pay back the interest that is supposed to be given to the bank. So that asset is now taking the form of a liability. And of course, when that asset is not going to yield any amount of money, then slowly and gradually it will affect the liability sector also, because the bank is not going to earn any profit, any additional money. The profit has gone, it has gone down the drain. Then in case the additional money, the interest on which these liabilities, although these can be ignored for now, they have to be whatever profits the bank is earning or not, has to be returned at the end. But whatever liabilities here, the loans, this is necessary, you cannot ignore them. If the debtor, if the creditor, he decides to take you to court on the basis of you not returning his money or other debt securities, that you are not going to, not being able, the bank is not being able to go, then the bank is going to court, and then the situation is going to become devastating. So this is the basic structure of the bank's balance sheet. Now this is the actual balance sheet a little in detail. This is necessary to study, just an emphasis or overemphasis, a delineation or debriefing or the documentation that I have created. I have not, if you notice, I have not created the actual structure, because I am not a chartered accountant or not an accountant at all. Basically, we have discussed already the asset side from the banks. We have discussed the loans to the customers, then the other investments and cash. Then we have what is known as fixed assets. Fixed assets include tangible assets, intangible assets, capital work in. No need to go into detail in these terms. Basically, fixed assets, if we study in the crude form sense, fixed assets, they cannot be moved, or they are stable, they are going to stay with you for a long period of time. Fixed assets, we can normally study in the terms of PPE. In accounting terms, it is plant, it is plant, property and equipment. So what we mean is the property is a land which an entity has purchased. Plant is what the structure or the factory which that entity has created on it. And finally we have the equipment, what the machines, whatever the instruments, whatever the tools they are using in case of this, in case to run their business. So basic intangible assets. Tangible assets include this, which can be seen or touched in layman terms. Intangible assets include assets such as goodwill, which can only be established by a fiduciary relationship, a relationship of trust. Then we have the current assets. Current assets are normally which are assets for a short period of time, normally less than a year or less. We have current investments, trade receivables, cash. Here we have the account. This is also known as the account receivables, which we will be discussing in the, and the equity and liabilities part, which we have already studied in the easier manner. Those include the equity, the capital or the equity, that is the share capital, reserves and surplus, that we discussed in the equity part. And this is the major liability parts. Again, long term borrowing, long term provisioning. These are like the fixed assets, the opposite of fixed assets. These are liabilities which exist for more than a year, more than 12 months, and current liabilities. These are short-term borrowings, trade payables, short-term provisions which have to be incurred, the liabilities. The money has to be returned within an year. Then some more terms. Basically, bad loans are largely loans which haven't been repaid for a period of 90 days or more. Bad loan is just a banking industry term for NPAs. Accounts receivable, we had discussed the accounts receivable or trade receivables as we call, is the amount to be received from the customers, also known as debtors. So in this case, this is important concept which we'll be discussing how it is related to our present lecture. Then current liabilities are the obligations that will become due in the current period within a year and generally includes trade due to vendors. Just a definition, it is similar to what I've explained. Then current assets, those which can be liquidated within a short period of time, that is within a year. Then fixed assets are items that are physical assets that can be touched or seen or felt and are owned by the company for a long time. Then capital represents the money invested by the owner in the entity. It is the total assets minus total liabilities, which we have already discussed. Then under the provision methods, we have discussed the short-term provisions, the long-term provisions, the liability. What happens is, provisioning is an important concept. In provisioning, what happens is that if you think it is a sort of a measure, it is a sort of money or amount that has been set aside in case an asset goes bad. That is, if a loan is going to turn bad, and if you know that the loan, one of the loan that is an asset for the bank, that the customer is expected to return to the bank and with interest, if that person is going to get bankrupt or insolvent, it is good to have some provision, some money, whether it be equivalent or it occupies some part, so that when the loan is written off, when the loan becomes ineffective or it becomes unyielding or it becomes unprofitable, then that additional money that has been already earmarked, it can be written into the trade or account receivables. So it will become essentially an asset because the cash was already earmarked, it was not meant for anything else, so that will become receivable. We'll be discussing this in the debt restructuring method also. So basically you have to remember this for now. Then under the provision method, when you determine that a customer is unlikely to pay, you enter a debit to the provision. And for the bad debt account, and a credit to the account receivable for the written off amount. This equally reduces the balances in the account receivable and provision account, thereby leaving the net value of year unchanged. Don't get confused. Not everything in accounting is done on a balance sheet. There is something known as the income statement and the cash flow statements as well. So this debit and credit which are occurring, they don't actually happen directly on the balance sheet. They are done through the income. And debit and credit not to go into detail, it can get confusing because sometimes debit and credit are misinterpreted. But basically the thing is, the important when the loan is written off. What is writing off a loan we'll discuss, but when in general terms, when the loan has become bad, it will not yield, it is not more anymore an asset, then that loan is kind of, in layman terms, it is written off, it is removed from the balance sheet, and that provision which was there to for the rainy days, that has now gone to the asset side, the trade receivable sides. Now some more terms, just to make it clear, we were discussing about write off. There is another term known as write down, and there's another term known as write back. Don't be afraid, I'm here. Write off. A write down, first we discuss write down, performed in accounting to reduce the value of an asset to offset a loss or expense. Now, for example, an asset, suppose a company, the company is worth, company we can say it is worth 5 crore. But due to a fire or some unforeseen circumstance, or if the assets are going back, now it is not worth that it used to be earlier. So written down value will be accomplished. It is not just we can assume a random value. It is going to be calculated on the basis of the assets or the inventory, the assets which are safeguarded, which were not affected by the fire and are still profitable and make up a hefty amount for the profit of the company. So that 5 crore, it might not be worth 5 crore anymore, maybe now it is worth 2.5 crore. So this amount actually will be reflected in the balance sheet. So this is the written down amount, so that the whole 5 crore, we don't have to see that whole 5 crore is lost, but written off. Finally, if the entire building unfortunately uh, goes, it burns to ashes, then if we know it is not going to yield anything, it is going out of business, whatever assets are left, they have to be sold, then the written off, what we have been discussing, that write down, that reduction in value goes to zero, and that has to be removed from the balance sheet, that is the writing off. A write down becomes a write off if the entire balance of the asset is eliminated and removed from the books altogether. Write off, just additional information, write off or this transfer of resources is also done in order to make that balance sheet a little more pretty or acceptable, because whatever loans or whatever funds or debts or the bondholders, whatever creditors will offer the money in the future, they will look at that company's balance sheet, and if they see this as a loss amount on that balance sheet, if this has not been written off, then it will give a bad, the rating, the so-called rating or the trust. They will not be interested in investing in this company or the bank anymore. When we discussed in the beginning that the NARCL or the bad bank is expected to write off, the banks have already been writing off NPAs or bad loans of the equivalence of 10.8 lakh crores of rupees over the last, so that is what writing off connotes or means in this scenario. Then we'll get to this. Bonds and debenture, we had discussed in the liability side of the bank's balance sheet. A bond is a fixed income instrument that represents a loan made by an investor to a borrower, typically government or corporate or government, in this case, bank. Then debenture, in a sense, all debentures are bonds, but not vice versa. When we talk of a bond, we particularly talk about G-Secs, the government securities, the gilt-edged securities, which are actually secured loans. They are secured loans and unsecured loans. The debentures are normally unsecured loans. In secured loans or secured the government securities, you are entitled or the right to the interest or the full amount. You are bound to be compensated with, even in case of liquidation or an entity or a bank going bankrupt or insolvent. So in a sense, all debentures are bonds, but not all bonds are debentures. Whenever a bond is unsecured, it can be referred to as a debenture. The nominal value when we are writing down a loan, or the government is issuing a bond, or the in the liability side of the bank's balance sheet, when it is issuing a certificate, debt certificate, that value, the nominal value that is written on the paper, that is known as the nominal, the face value. is its redemption price and is normally stated on the front of that security. Now there are various types of bonds. There are zero coupon bonds also. Now zero coupon bonds are again just for additional information. A lot of information has been endured already. Normally what happens is when a bond is issued, the nominal amount or the face value which is written, after a certain period of time, that will bear an interest. In case of zero coupon bonds which are normally issued by the governments, the bond or the certificate is purchased by the other entity at an already discounted amount. So it is in this form, in you can say that in layman terms, the interest has been already offered at the beginning, and the face value, the nominal value which has been written on that zero coupon bond issued by the government, that face value will be returned at the end of the maturity or after the period at which it is supposed to be, the money is supposed to be returned to the investor or the citizen or the individual or the financial institution. So that face value, because you already purchased, what more do you need? You need the government to pay you more money? No, that is not going to happen. And again, we have already discussed the saving versus investment. The saving is act of putting away money for a future expense or need. When you choose to save, you want to have that cash available quickly. Slightly different from investment. You investments which include the bonds and debentures and again the securities, you cannot withdraw them immediately, but in savings account you can go to the bank and whenever you want the money you can get it. Then investment, similar to saving, except you are looking to achieve a higher return in exchange for taking on more risk. More money means more risk. Then typical investments include stocks, bonds, mutual funds, exchange trade funds. We'll not go in that, is off topic entirely. So that is stocks. Basically, we are investing in markets. So we cannot directly, one day the stock goes up and we're withdrawing money. We cannot do. It's a sort of, it's a period which has to be then. Moral hazard is something which we'll be discussing, why we are going to discuss that. Now commits the bad loan. I have explained in a flowchart in a simple word, although you know by now that the asset, that is the loan, why it has become bad, because the person or the individual is a defaulter, whether he is a willful defaulter or whether he has actually gone bankrupt or insolvent, that is a different case. So now the first thing is bank is functioning normally. It is taking deposits, it is issuing loans, it is taking in debt, it is the assets and liabilities are going hand in hand, and bank is obtaining its necessary profits. But here comes arrival of Uncle Malia, Kingfisher, of course we can relate. Then I've just put recent terms or build more into this, is an icon of Money Heist, which is a very famous show now on Netflix. And then when he is not willing, now he has just fled to UK, and now he is not willing to return not only the interest but also the principal, and that is a huge amount. So now that has become a bad loan. Simple, not to dwell on it much. And what will happen is when the bad loan, it will have two major effects on that bank. First of all, the bank will become less profitable. Why? We have already discussed in the balance sheet. In the balance sheet we have discussed the asset in the case of the bank, which used to be the loan. Now that loan is no longer an asset, and that loan is no longer an asset, and the liabilities, that profit is not coming, and that profit, that additional money is not available to pay to the creditors. So the bank becomes less profitable, and again this will lead to this scenario. Bank will have to use some of its profits from the other loans to make up for the loss on the bad loan. So already the liabilities which are there, all the savings deposits, that have to be returned to the customers as and when they desire it. The money from that has to be deviated or to a different conduit to make up for the loss. Then second, if major effect is bank becomes more risk averse. Obviously, we are talking about so many incipient MSMEs, the small startups. Why? This is a personal experience why the banks, even those dedicated to those MSMEs, why they are unwilling to give loans to that customers, because already they are reeling under the adverse effects of loans going bad. And obviously a startup, it will not have any balance sheet, it has just a newly become company, or even the companies who have been just active, who have just been in the business for the past 2 or 3 years, there is no solid foundation or balance sheet to prove their credentials. So obviously the bank officials will hesitate from extending loans to business ventures that may even remotely appear risky and aggravating an already high level of NPA. So that is why even the noble or the hardworking, sincere aspirants of a new startup who are sure that they will not enter into bankruptcy or insolvency, but the market, it is a globalized economy, everything is interconnected. One thing, you can see the recent scenario, because of the COVID, even the Oyo hotels, the Oyo owner, he suffered huge losses. So that basic pandemic comes, the global financial recession that was triggered by the big investment banks of the United States, the financial crisis of 2008, 2009. It had devastating consequences all across the globe. So that simplest of things, even in a movement of a not in a movement, it takes some time to build that bubble. So that can drastically reduce the value of any asset. Now again, some additional information which I am putting here and there. Loans which have been bad loans for 4 years, that is for 1 year is the substandard asset and for 3 years a doubtful asset, can be dropped from the balance sheet by way of write-off. Write-off we have already discussed. These new categories of NPA we are going to discuss in the next slide. Then a non-performing asset is a banking industry term for a bad loan. So essentially they are one and the same thing. One that has not been repaid within the stipulated time or where the scheduled payments are in arrears. Now, before we move on, we need to understand the classification of NPAs. We already studied that the NPAs, now not all defaults, if I am defaulting on day one, like I took an example, if I have taken a loan for home loan or a car loan and I am going to pay it, I am supposed to pay it after a period of 5 years. Then if on 5 year and the first day I'm not able to pay it, it does not become an NPA all of a sudden. So first of all, the loans, the advances, which are the assets for the banks, they are categorized into standard and non-performing assets. We have discussed that non-performing assets, like after the 5 year period has gone, it has traveled behind, the additional, until and unless I go through a period of 90 days of delay more, it will not become an NPA. So for standard assets, we have regular, there is no delay whatsoever. The payments are going regularly or the interest are going regularly in installments to the bank. Then stressed assets, we have 1 to 90 days delay. This is just a classification, and we further the stressed assets have been classified into special mention account, that is SMA. Again, SMA 0, 1 to 30 days delay, SMA 1, 31 to 60, SMA 2, 61 to 90. It just gives an apprehension, or it is a way to categorize or segment the loans into different areas or regions according to which the appropriate measures can be taken to save that particular asset or make that loan viable again. Then we have the non-performing assets. After it has exceeded the period of being stressed, it is more than stressed, now it has become a substandard asset, NPA for up to 12 months, and then doubtful assets, NPA for greater than 12 months. So we had discussed what is the precondition for a bank to write a loan or to write off a bad loan. That is, first it has to be an NPA, already 90 days delay has occurred, Then 1 year has gone by, still the loan is in default, the full payment has not been done, it has become a substandard, and even the 12 months, the 1 year period has gone by, and we have gone to the category of doubtful assets for 3 years, that is greater than 12 months. This is the time when the bank can decide that it is high time that the loan should be written off the balance sheet in order to save off, or in order to digress from writing more bad loans. Then finally, when the bank has reached the conclusion that it is non-recoverable, it has no chance of yielding profit or money or getting the return which it was supposed to get in the first place, it is going to be a loss asset. Some more terms, provisions I have already discussed, just a definition: an amount set aside to cover a probable future expense or reduction in the value of an asset. So we had discussed provision is when a loan is getting written off. It has been categorized as a loss. So the amount in the provision side, that is the liability side of the button is not available. It is on the liability side of the bank's balance sheet, the provision that, and it goes to the asset side, that is on the accounts or the trade receivables. Provision, why I have put this fruit basket, vegetable basket in this, because it is, I love relating things relating the environment and various issues. Basically, you can relate provisions in layman terms to provisioning of food. For example, if you remember that a story of a grasshopper and ants. In the summer season, the ants, they make provisions, or they gather the excess or the surplus food for for the rainy or the winter days when they cannot work or go out. But the grasshopper is not, he is just relaxing. So ultimately you get the gist. So similarly in the real life also, provisioning, when we get the buffer stocks, we try to get buffer stocks of the grains, the wheat, rice. So in case there is any loss due to the erratic or the unprecedented or unseasonal rainfall, and it affects, or the droughts which affect the farmers drastically, so that provisions of food can be used to feed the entire population. Then why is the provision being created? Because they account for certain company expenses and payments for them in the same year. This is the, and again there is a difference between insolvency and bankruptcy. Insolvency is the inability to pay off the debts due to insufficient assets. Bankruptcy is the application made to an authority declaring insolvency and seeking a total discharge of the assets, that is the sale of the assets. Insolvent is still basically what we do, what I'm going to discuss an example also. If even if the company or that bank is not able to cater to its liabilities or not able to pay back the interest, it is becoming kind of insolvent. But that doesn't mean that those assets cannot be recovered. That is where the bad banks actually come into picture. The bad banks are here to restructure those assets, because there can be a possibility in the future that those assets start working again, start becoming profitable again, and those liabilities can be compensated for. But if the entity or the bank or any corporate organization, it is sure, it has decided that it cannot cater to the liabilities anymore, all its assets have become unprofitable or become loss assets, then it issues an application, it declares insolvency, and it issues an application, and finally in layman terms, the auction or the boli of these assets, until all it is all the company, the entire company is liquidated or discharged, it will go. And again, just a term comes to my mind in in political science also, we have a criteria for the disqualification of the MPs or the member of parliaments. One of those is the undischarged insolvent. For example, he's an MP, he has become insolvent, he is not able to cater to his liabilities, whether he's involved in corruption or whatever, no need to discuss, but he is still not declared bankruptcy. So in that case, he's liable for disqualification from his seat from the parliament. You can study in detail in the political science. Now this is collated collateral data. Again, I love to play with words. Collated means I have just assimilated the major data. I have not just copy pasted any graph. I have taken the time out just for the audience who have tuned in to give him a nice presentation. And collateral is something sort of when you take a loan, you give a collateral or you keep a house or another asset as a security. So that is just collateral. Just have wordplay and nothing else. So two things, major things I have shown. Basically, I have the NPAs are normally they are studied in terms of gross NPL ratio, that is the percentage of the bad loans or the non-performing assets as compared to the entire loans. So non-performing loan ratio, as we can see, it was very high in 2000, then at again 2018 it again 11.4% and 2.3 the major landmarks or the major nick points, and finally at the end of the 2020 in the first quarter, we can say 2021, they have gone to 7.5, but still the situation is quite dire. And then we have another term known as the slippage ratio. These are the actual percentage of loans. This is the rate at which at the start of the year the loans have a tendency, or the rate of getting into forming the non-performing assets. So again, that is not a healthy picture. So that is just for additional information. But what is happening is the banks are the backbone of any financial structure or the economic conglomeration of any society or a sovereign nation for large. So if a corporate organization is going to get insolvent or bankrupt, a government is normally not going to pay any heed. But if a public sector bank is going to get bankrupt or insolvent, as has happened in the past also, the government is definitely going to take some austere steps. It is going to infuse more money, or we have the term known as recapitalization, which is going to be additional money infused in order to cover for the losses that have been already incurred by the insolvent or the uh, stressful asset laden bank. But where is that money coming from? That money is coming from the pockets of the taxpayers, that is the common man. So from the taxpayers perspective, the most worrisome fact was that an overwhelming proportion of NPAs was with the public sector bank, which were owned by the government and hence by the Indian public. To keep such PSBs in business, the government was forced to recapitalize them, that is, use taxpayers' money to improve the financial health of PSBs so that they could carry on their usual process, day to day business of funding and lending, and resume the economic activity. Because if the recapitalization also doesn't happen, then it is going to have a chain reaction, a fission reaction, and it will lead to businesses collapsing on a large scale. But it's ultimately the taxpayers money. So all these things, whatever we have discussed, the bad loans, the NPAs, the investments, liabilities, in order to safeguard these banks, in order to prevent such mishaps from happening in the future, we have been taking certain measures, and the recent measures of bad bank is one such important measure in that regard. Before we get to the actual bad bank, believe me, it's going to be a short topic, because the basics which we have discussing, those were supposed to be discussed in detail. That those topics is what is going to make the study or the discussion of bad bank very interesting. Insolvency and bankruptcy code. This was introduced by the government in 2016. Then again, keywords, that is what I do. The why, when, who, how. So why was the insolvency and bankruptcy code? It was basically to save, or it was save the assets or restructure the debt or the assets of a particular corporate entity, the LLP, the partnerships and such this. But the bad bank is specially made, especially being restructured, has been created for safeguarding of the assets of the banks. So the IBC was to speed up resolution of the stressed assets in the country, and whom was it applicable to? Individuals, partnerships, LLPs, and corporates. What is the time frame? What are the major steps or the periodic nature? Authorities to decide insolvency application within 180 days, because we know that once a company, once a debtor or once a creditor or bond funder of a particular company goes to court, then it gets pending for decades and years. And there is also in the code, it is also an option of expediency or fast tracking the insolvency process, that is 90 days available for specified entities. And who is the adjudicating authority? We have the NCLT, National Companies Law Tribunal for corporates, and debt recovery tribunals for individual and partnerships. What are the major steps? Just a bird's eye view. On day one of default, creditor or borrower can approach NCLT to initiate insolvency proceedings. Then, once the case is admitted, lenders will constitute creditors committee, appoint insolvency professionals who will run the borrower's company in the interim period. Within 180 days, the lenders committee has to decide on a debt recast plan. Lenders can have additional 90 days to arrive at a final plan, and if 75% lenders agree, the committee would go ahead with the debt or the asset recovery structuring, and otherwise the process of liquidation. That is what I was talking about when I said that if the company can be saved from bankruptcy, then this procedure can come into existence. Now, if you are confused about a debt recast and what lies at the helm, what lies at the systemic procedure of the working of the bad bank or any asset reconstruction or debt reconstruction for that matter, I will gleefully explain you with an example. Let us consider a hypothetical balance sheet. Normally, a balance sheet would look like this. This is the asset side. This is the liabilities. And this is the equity part. This is the equity, capital, and liabilities or debt part. And we know from the accounting equation that assets equal to the summation of liabilities and equity. Kindly pardon my good handwriting. Anyways, so let us assume this is the structure of a company's balance sheet or the company as a whole. So now the assets have to be reconstructed. Why? Because the assets are turning back. So that debt recast plan, and that same plan can be, when I said in the beginning, there are many ways to restructure assets. Basically, if initially just consider that a company was worth 10 crore 10 crore rupees, and an assumption, and out of that 6 crore rupees were the liabilities, debt, and 4 crore was the equity part. Now these loans or assets, whatever the company these owes to the creditors, now these are going bad. So how to? First, it is somewhat we can writing down the value. The assets have gone down, and instead of liquidating the company, why aren't we not selling the assets directly? Because the company, the entire 10 crore, it is not necessary that they are going to get the entire amount or even half of it or even a fraction of it. There is no guarantee. Moreover, when we discuss the assets, the fixed or the tangible assets of the country, the PPE, the plant property and equipment can be sold. But what about the plant or even the property? Land has to be purchased. There is land has to be purchased on which the factory or the plant is set up. What if no one is willing to purchase that land? That is a major asset, land. It is not going. Some farmer will purchase it, or some other entity will uh, get a brownfield or a greenfield entity on it. So that land cannot be sold easily. It will not be even the plant, the factory. What if the factory is no? It has to be taken down. It cannot be sold. It cannot be converted into a horse or animal stable. So that plant will not give as much benefit if it is completely liquidated. Moreover, if a company is in default, it is not able to pay off liability, it does not mean that it has stopped working. It is still generating some cash. The only point to note is that cash is not sustainable enough to fulfill or compensate whatever interest or the money that is owed to the creditors or the persons who have supplied funds to the company. These equities are the last one too, so they can be ignored for now. So what happens is the restructuring. The major term has to be restructuring, or the writing down of the value of assets. Again, we talk about molding the pottery. We have to mold the assets in another manner. So various companies, where various all the asset holders companies, they will probably get some institutions, some lawyers to get this value adjusted. So what will happen is, maybe we can say that the company is no longer worth 10 crores, maybe it is now worth 5 crores due to various calculations, how the assets, that we will not go into detail. And out of that, rupees 3 crore can sustain the debt and 2 crore is worth of equity. So the structure, in layman terms, it has been structured like this. But what will happen in this case, the debt holders are the senior most. So these debt holders, if we consider the debt holders are the senior most, who have to be compensated for their money the first whenever the company goes into liquidation, or company has some cash to accrue or give to these investors. So these senior most 5 crore, these 2 crore and this 3 crore, they will go to this senior most debt holders, which used to hold a debt of 5 crore. Now you can see this 2 crore is actually the equity, not the debt. So it is kind of a method of restructuring, that is debt equity swap, that is used, one of the methods too, which are used for asset or debt restructuring. So now the value that has been come to, okay, let us assume they have all the debt holders, the asset holders, the equity, they have come to the conclusion, okay, it is worth 5 crore, out of which it can sustain a debt of 3 crore and equity 2 crore. Now we have to remember, that is equity. These are not the old shares, these are the restructure, this is the new equity. But since the bond holders are the topmost, they're the senior most funders, so these 3 crores will go to the debt part. And not only that, since we have to satisfy all the debt holders, the 6 crore, the primarily the compensation will go from the 5 crore to those holders. But 2 crore, you have to observe or notice that 2 crore will not be in the form of debt anymore. It will be in the form of new equity that has been created, or new shares that have been created. So why would the debtors accept that? Because the debtors have to assume that instead of selling all the assets and returning home with much less profits, although they are the senior most, and we know that often the entire bankruptcy proceedings, or if it is selling or liquidating all its assets, it is not necessary that the company will get. So in order to salvage something, it is okay if 3 crores of debt still is able to be some of the creditors, and rest of the 2 crore equities in case of death, that 2 crore debt holders now hold the 2 crore equity, and rest of the money, these will probably lose out the 1 crore debt holders which were earlier, because no money is left, and obviously the equity holders will go empty handed. This is one of the ways of restructuring. This is a hypothetical example, but this is how the restructuring is more or less done. So this is what the debt recast plan, and this is what we have been discussing, that if 75 lenders agree, the committee would go ahead with the debt restructuring, maybe some sort of plan which we have discussed on the empty white screen, and otherwise the process of liquidation will start if it is of no use. Now finally the banned bank, but I assure you that we'll going to finish off in the next 15-20 minutes. Because we have comprehensively in-depth analysis we have done of the basics. Firstly, we know what is a bad bank, we know asset investment, almost every term which is important. We have the bank. It is funded by depositors, but now since it has developed stress assets, it has developed a messy balance sheet. We have already discussed in depth. Now those the profits have to be derived from someplace else. Now that bank, in order for that bank to become a good bank, now what will a good bank signify? A clean balance sheet funded by depositors, open for growth. That bank will give its bad assets from the messy balance sheet to the bad bank or separate entity, that is the NARCL, that is the National Assets Reconstruction Company Limited, that has been created by the government. Then funded by specialist investors, government, and in runoff phase, it has to basically cater to the ring fence loans or the bad loans. The good bank, the bank which was stressed, now it has become a good bank. It can go back to the future, and it can release provisions held against the NPAs. We had told that we had been writing down and writing off the loans. Now, since those provisions are free, those money earmarked, that NPAs have already gone to the bad bank. Now that excess money can be used for other lending or funding purposes. Easier to raise capital from investors. Why? Because not only the balance sheet has become prettier, but now since they know that the government is there to, and the separate entity is there to take care of the bad loans, so they have no incumbent bad loans as such, and they can be safeguarded of their investments. Then it has the potential to grow and expand. And this bad bank, being bad, the sole focus would be on winding down the ring fence loans, that is obtaining, restructuring the bad loans in various ways, which we have discussed already, either by restructuring them, resolving them, or selling them. It would be designed akin to an asset reconstruction company. The bad bank is a catchy term, and that is why if we use ARC, asset reconstruction company, okay, it is another a term, fancy term, but bad bank, it straight away catches attention, makes it interesting. Temporary, it is a temporary measure. It's like an aspirin for now. For now, Indian banks will likely give a much needed sigh of relief that, but the thing is, because it is already difficult to resolve the assets, like we discussed, it will not be able to exchange the bad loans or the bad assets in return for some fruitful investment. And even in someone, the stock market or the debt holders, they or the creditors, they are willing to purchase those bad loans or bad assets. It is not necessary that they will give the face value or the amount on in full. They will probably give down the written down value. Then the mechanism will be, it will buy these stressed assets for a mix of cash and government guaranteed security receipts, which we'll discuss what the actual norms in that act or policy is said by the government. Majorly, it will be 15% cash and 85% in security. Cash means upfront cash. Then certainty, if it works as intended, bad bank may cut system-wide NPA, non-performing assets, by over 1% and may be able to recover some bad debts also. And contingency, the government guarantee on SRs enables trading of these securities. That is a 36,000 crore guarantees, because cash is already given in exchange of bad assets, whatever the written down value of the bad loans is. So those bad loans, for return, 15% of that bad loan value, written down value, has already been given to the bank, and the rest of the 85% leftover value will be given in the form of certificates, traded in the form of certificates, and those securities can be traded in various measures. And this is the basic structure or basics of the bad bank. Okay, now asset reconstruction, we have already discussed a very good hypothetical example a little bit in detail. An asset reconstruction company, special type of financial institution that buys debt of the banks at a mutually agreed value and attempts to recover debts or associated securities by itself. It is registered under the RBI, Reserve Bank of India, and regulated under the Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Acts 2002 SARFA-AC. And a tough time remembering the exact expansion of the term. Anyways, so basically, this is the the description of an asset reconstruction company or the bad bank. Now, what important features are involved in the asset reconstruction? First of all, like I said, this pottery remolding of the assets in the form of written down coming to an agreed value of the bad assets. It is the acquisition of any right or interest of any bank in loans, advances granted, debentures, bond guarantee for the purpose of realization, and such loans, advances which are given, they come under the umbrella term of financial assistance. There's no rocket science involved in this. Then we have the securitization. Apart from the asset reconstruction company or the bad bank that is going to take over the loan, there is known as a securitization, because 85% are also going to compensate for the bad loans in the form of security receipts. Acquisition of financial assets either by way of issuing security receipts to qualified buyers or any other means. We'll be discussing qualified buyers below. And such security receipts would represent an undivided interest. The term security refers to a fungible, negotiable financial instrument. Some more terms: fungible is basically whatever you are taking, whatever you are offering, the funds, they have to be returned in the same. For example, if you give 100 rupees, the 100 rupees cannot get you gold in return. 100 rupees have to be returned either in the denominations of 50 rupees and 5 notes of rupee 10, or another example is 220 notes, 150 notes, and 110 rupee note, but not any other asset. That is the basic meaning of fungible. And negotiable financial instrument is that, like we have a check, when you issue a check to you deposit check in the bank, then you are bound to receive at a definite amount at that particular value. Then qualified buyers include financial institutions, insurance companies, banks, state financial corporation, all this, who are registered under the SARFA-AC Act. And the qualified bankers are the only qualified buyers are the only persons from whom the ARC can raise funds. So after the ARC has acquired the bad assets from the bank, these qualified buyers are the only ones from which it can engage in the process of selling and resolving or getting back the value of the bad loans. Because obviously, if the again those asset reconstruction companies are already going to sell or realize its value, try to realize the value of the bad assets from some another unsecured or doubtful institute, then it is going to create another chain reaction of chaos. Now, how can the asset reconstruction, what is the option of remolding for the ARCs or the asset reconstruction companies? Some of the ways are change or takeover of the management of the business of the borrower, because ultimately it is also the management's responsibility to conduct operations in a fruitful and a mutually trustworthy manner. Then rescheduling the payment of debts, offering alternative schemes, arrangements for the payment. Maybe we can delay the debtors can delay the delivery or the resolution or the deposition of the interest that has been guaranteed to them. Maybe some in maybe in the future the bank the bank or the corporate company, it starts getting the desired profits, and then those profits can be used to reimburse the debt holders. So the some modifications can be made. Then taking possession of the assets offered as security or sale or lease of such business is simple. Then enforcing the security interest offered in accordance with the law, take that company or bank to the court, and or converting a portion of the debt into shares, which we had discussed in the hypothetical example. Now, structure of the bad bank. Believe me or not, we are going towards the end of the presentation. The National Assets Reconstruction Company has already been incorporated under the Companies Act. It will acquire stressed assets worth about 2 lakh crore from various commercial banks in different, and it is another entity there, India Debt Resolution Company Limited, IDRCL. So basically two companies, NARCL will acquire the bad assets, and IDRCL has the function or the purpose of selling them. Just basic distinction is this: it will try to sell the stress assets in the, so this NARCL IDRCL structure is the new bad bank. How will it work? The NA, we have already discussed. The NIRCL will first purchase bad loans from the banks. It will pay 15% of the agreed price or the face value or the written down value, and the remaining 85% will in the form of security receipts. When the assets are sold with the help of IDRCL, the commercial banks will be paid back the rest. So 15% cash is already paid upfront, and the rest will be paid after the assets, the bad loans, the bad assets or the bad loans, the value has been realized. Then provision of write back. We had discussed the write down, and now there's write back. Basically, write back, it is a reversal of the write off. These loans are fully provided in the books of the bank. The upfront cash received, 15% of written down value, would be reversed, while the provisions for the balance value of security are unlikely to be reversed even if it is fully provided. So already the bank is in the form of getting, has the benefit of receiving extra money from an outside entity. Bank is getting additional money, so why would the entire 100% be given on this balance sheet? Basically, the recapitalization or the infusing of capital has to be done. Basically, the provisions which were used for the bad assets and the assets have actually gone bad, the 15% of the written down assets, the that would be sufficient, considered sufficient enough to go into the balance sheet, and it would be catered or compensate for the assets gone bad, and that 85% value will be returned back later, but for now the 15% will go on the balance sheet. Then in case the security receipts or the bad loans, they are not able to get realized or being resolved in the various mechanisms through the market, or the buyers are not available, then that difference in the written down value on the government receipts and whatever it is actually sold for, the assets are sold for or not sold for, that will become again a headache for the ARC, because it has got the bad loan written down value, but it is not being able to sell it. So for that drawback, or for to compensate for that loss, the government guarantee is there. The government has earmarked 36,000 crore of rupees to safeguard that loss. So that is the government guarantee will cover any shortfall between the face value of the receipts and the actual realization of the bad loan. Then this imparts credibility and provides for contingency buffers. Government guarantee of up to 30,600 crore will be backed security receipts issued by the NARCL. The guarantee will be valid for 5 years. Why this short tenure is required, limited tenure will be discussed. We had digressed from discussing moral hazard, because if an asset reconstruction company is going on, it is taking in bad loans without any systemic reforms, the actual reforms or due diligence in the lending process, this situation is not going to improve. The condition precedent for invocation of guarantee would be the resolution or liquidation. Then again, resolution in the key. How efficiently the professionals are resolving the stressed assets is to be monitored. One can argue that bad bank is likely to become a warehouse for stressed loan without expected recovery, as it will be difficult. That is what we are uh, trying to avoid. Even if when the bad bank or the NARCL and the IDRCL, they are just accumulating stress assets, because without being able to sell them, that it will just become a go down or warehouse on the stable to just accumulate the stressed assets which are not going to get the economy anywhere. And it is also difficult to find buyers for legacy assets. Legacy assets means, in simple terms, for example, we have slowly gone from in the music industry, we have slowly gone from that rotating disc. I like don't remember that the rotating disc which came, and that pin was there. Then we have gone to the cassettes, and then we have gone to the CDs, and now we are simply downloading the Spotify and OTT platforms. But what is, if this is also an asset of that particular company, if we say, but this asset is now not useful, it has become a legacy asset. The same analogy can also be applied to particular bank or ARC or particular corporate entity. Then the net effect, the resolution of the proposed rupees 2 lakh crore of legacy stressed assets will lower the gross non-performing loans by more than 2%. The estimated realizable value of 18% will lead to provisioning right back of rupees 36,000 crore. This is the estimate. If all things go according to plan, then this reform is definitely going to pay off. Now, the good, the bad, and the ugly. If you don't know, it's the title of a famous Clint Eastwood movie. Anyways, there's some obvious problems with the banks. They can entice moral hazard, can inflate prices, and have to make do with the limited secondary market for illiquid assets. While recapitalization and such guarantees are designated as reforms, they are mainly bad. They are mainly band-aids at best. That is what we had discussed earlier also. Although they are definitely reforms, but they have to be carried out ardently and with diligent approach in order to give it a firm surgery and not just a band-aid. Because like we said, if the ARCs are just going to purchase the bad assets and going to accumulate them, we are not going to go anywhere. The only sustainable solution is to improve the lending operations. Make sure that people like Malia and others, they don't find loopholes in the bank. All the loopholes need to be dealt with in a diligent manner. And we're talking about moral hazard. Moral hazard is what happened during the great financial crisis or the depression of 2008 2009 in America. What happened was, the investment banks, they had started selling their already bad assets in order to gain from the short term profits at an inflated price. They were they had become a prospect or a source of bad loans by themselves. So already the bad loans were there. In that situation, only the bad loans were there, and those bad loans, the bad assets, were further sold at different inflated prices in order to get profits, in layman terms. Similarly, what can happen, what is the bad side? Bad can be happen that the ARC which has been constructed, the bad loans are already going to the ARC, but in the haste, that 5-year tenure period, the ARC, it might happen that the ARC, in order to dispose of its loans, or in order to make profits, in order to realize the written down value of that security receipts quickly, they might start selling it at inflated prices to further entities who might not be able to repay them in the future, or they might create further bad loans. So this ARC might become a bad investment bank in itself, and it will then start inviting more investments. It will more start inviting under the table or murky or doubtful investments, which might become stressed assets. So it will compound the stressed asset effect. Already stressed assets are there in the ARC, and if I don't want that to happen, but if the ARC is unable to sell and it decides to become an investment bank of its own in order to dispose of its bad loans, it is going to again create an economic bubble that led to the collapse of the great investment banks like JP Morgan and Goldman Sachs in the United States. We don't, that is the bad part. But the good part is that there, these these reforms, the reforms like that resembling the ARC, they have already proven to give effective results in some countries. They have been experimented with under government aegis and successfully too. US, Finland, Sweden, Germany. The US had set up an ARC named Resolution Trust Company, which operated between 1989 and 1995. Stockholm, the capital of Sweden, responded to a banking crisis by setting up Securum, which had disposed of 98% of its bad assets by the time it was dissolved in 1997. But again, there are warnings from abroad where the situation of the reform was not as healthy as was desired. Research has shown that the proliferation of such state-backed ARCs incentivized a culture of moral hazard. Before we go, we had not discussed this moral hazard thing. Moral hazard, the risk that a party has not entered into a contract in good faith or has provided misleading information about its assets, liabilities, or credit capacity. Basically, what happened to the investment banks in America, it is basically a breach of goodwill, a breach of trust, that their assets will not become stressed or get converted into bad loans. Coming back, so this Yurong was a sort of ARC in China, and since we are discussing China, we all know how prone it is to hazards. Then over time, its mandate was broadened to such an extent that it became an investment bank rather than a bad bank, lending liberally to everything from risky real estate ventures and high yield cross-border undertakings. This created an ironic situation where the bad bank developed bad loans of its own. But what if, the ugly side again, what if the plan of bailing out the commercial banks, if all of this reform fails miserably, then again the public sector banks, they will be saved from any further debt or disaster, and they will be recapitalized by whose money? By the taxpayers' money. That will be the ugly side of it if the reforms don't work as desired. If that happens, guess who will have to bail out the bad bank? Indeed, the taxpayer. But hopefully, and I'm counting on it, this will not happen. This will work like the abroad affirmations in Sweden and US has done. So conclusion is, a bad bank could be again quick and successful only if the due reform measures. For example, we had established the IBC. It has dealt or it is suffering from such flaws, but that doesn't mean that we are not going to apply any reformative measures or we are not trying to improve the current fiscal situation of the country. The due diligence, we have to avoid moral hazard. In layman terms, we have to get rid of that corrupt mindset. We have to get rid of that shortcuts of end money. We know that all is going to be achieved, the good deeds, the goodwill is going to be achieved only through patience and perseverance, similar for any competitive examination. So basically, NARCL should have a finite tenure, that is, the guarantee also says that it will be 30,600 crores guarantee for a period of 5 years, and well defined and narrow goals. It should not go that okay, its sole purpose should be to realize the value, written down value of the bad assets or the bad loans. It should not assume the path of an investment bank. Then government funding and even involvement in this venture should be ideally kept at a minimum. State banked, although the guarantee is given, but it should not appear okay, it's a government's back, government has created it, so government has its own pecuniary interest. Already the government is dealing with a lot of criticism, but the government should not create an impression that it is only the state is doing something. It should be created as a free market, free competition. It should be market solution for market problems, because the government cannot government does not have control over creating or resolving the bad assets directly. It has to be dealt with in the market. A bad bank being a temporary fix, long-term solutions like ARC regulatory and bankruptcy reforms need to receive renewed attention to take over NARCL's mandate once it is dissolved. So NARCL is here to stay for now. It will serve as a band-aid, but the long-term surgery or the long term. Finally, I have posted this picture. This is a bank. So currently, the bank, the NARCL, will serve as an IV or a glucose. It will serve as glucose to enrich or give the energy back to the PSBs and try to resell or obtain the realizable value of the bad loans. But in the long term, we all know in the real life examples also, this insulin shots or IVs or the glucose infusion is not the solution. We need to fortify our foods to prevent us from malnutrition. We need to have our daily share of vitamins and minerals and whatnot. So that's healthy diet. And healthy diet does not, immunity is not built in a day or even a month. It takes a long period of time. That is a similar analogy that has to be exercised in case of a bank. Wait, hold on to your horses. I'm not going to conclude yet. For the examination purposes, although this was intended for all the plethora of our audience, but for the examination purposes, I've created a question, because this topic has assumed importance from the point of view of civil service examination. So just a sample question. It will cater to the JS paper 3, the topic economy, Indian economy and issues related to planning, mobilization of resources, growth, development and employment. So the question, I'll just discuss the keywords and how I believe the answer should be approached. In the wake of the slowdown in economic activities due to lockdown, the rise of non-performing assets is inevitable. In this context, critically analyze the need for the bad bank. This answer can easily be solved for whatever we have discussed. We have rather discussed in depth and the basic concepts also. You just have to realize the keywords and the directive word. Sometimes the examiner can ask examine or discuss or delineate some words. So critical analyze, every directive word has its importance. If we only say analyze, the examiner wants that we have to diligently break down, methodically break down the question into separate parts. We have to discuss what slowdown is happening in brief, non-performing assets. We have to break down, and then we have to give the body and the conclusion. When we are prefixing analyze with the word critically, we have to delve upon each and every aspect, the good and the bad, and finally we have to arrive at the fair judgment. I hope this is clear. So what in the introduction you can write, because in order to just cater to that requirement of discussing the lockdown, we don't have to discuss in detail. So in the wake of due to economic slowdown induced by the lockdown, credit rating from CRISIL held that NPAs are expected to cross rupees 11 lakh crore, and you can derive some data from the websites, and then you can give a brief definition of bad bank, which we discussed in the first slide. Then in the body, we can give in the bullet point form first the feasibility of the bad bank, because we have to discuss the need for the bad bank and we have to discuss both pros and cons. That will be done in the body. The feasibility, alleviating provisioning requirement, we have already discussed the 15% cash upfront that will free up the money from the provisioning. Greater reliability, segregation of good assets from and back from, and where it will give the avenue for the bank to resume lending operations, the funding operations, and get back into the economic realm. Then existing models, examples from abroad, why it is more feasible. We can the Securum asset reconstruction company from Stockholm, 98% of bad assets by 1997, then complements the IBC code. NPAs in the sector such as power can't be resolved from the IBC. This is an example. Power sector does not have feasible linkages. So bad bank may save a defaulting firm from liquidation and closure. Then the challenges, the possible negatives. Capital mobilization, unwilling investment, especially in time of pandemic. That is the written down value of the assets may not be realized. Does not address systemic issue. It's a quick fix. We have already discussed. Market related issues, limited means to sell illiquid assets, and again moral hazard we have discussed. Then a conclusion, bad bank seems to be a viable option to tackle the escalation of NPAs in the lockdown induced but structural issues, just a balanced conclusion, so that will effectively comprehensively fetch you good marks. So I hope you enjoyed today's presentation. So that's all. Till next time, Jai Hind.